Good to go.
Go.
All right, everybody, welcome to another episode of Real Estate Chat. I'm here with Robert Eade, and today we're going to be talking about a couple of reports, a couple of things with the outlook of the market, general state of the market, where I guess we can see things going, where you as an investor, a buyer, a seller, a renter, any involvement you have in the real estate market should be able to see this information and decipher it and what it means for you. So, hey, Robert, thanks for joining.
Well, it's a great day for real estate statistics.
Absolutely. And we're going to bore you to it. Depending on if you like stats or not, you're either going to be bored or you're going to be excited about this. So, Robert, where do you want to start today?
Well, the Toronto Real Estate Board announced yesterday that they're going to put out tomorrow, Friday, September the 2nd, at 5 a.m., one business day earlier than normal, their results for August, which is a wonderful thing, because rather than having to wait till sometime next week after a long weekend, we get to see what the results are now. So that tells us that either they take an extraordinarily long time to produce the results every month, or they're cheating this month by maybe cutting it off the 25th or the 29th or something or other, so they have enough time to do it one day early. Which
will be interesting because it does take them a couple of days. And we do have awareness of several stats platforms that run stats up to based on TRREB's actual data feeds. And you can calculate it based on that. However, we know that there's a discrepancy between that and the actual final report. Mind you, there's reports that, for example, a house sells on August 31st may not be reported until September 3, right? For example, right? Because for whatever reason.
So the thing with the TRREB is when I do mine, I always do reporting days.
Mm-hmm.
So I don't care when you actually do it or when it doesn't really matter, as long as you keep consistent. Same with TRREB. If they want to cut it off at the 25th every month, okay, just do it every single month the same way, and so that there's no variation from month to month.
Exactly.
So
exactly.
The interesting thing here will be, as you pointed out, everybody wants to know what these numbers are.
Mm-hmm.
What are the sales? And more than anything, what are the prices? Because based on that, then we confirm or have to rethink our previous, preconceived notions.
Exactly. And talking about preconceived notions, so earlier this year, you read the headlines, and as I was going through some of the reports that I'm going to be sharing with you, and Robert and I will be talking about, there were headlines such as RBC not saying that the crash, there's not going to be as profound as it is. This was back in April, and I'm just paraphrasing the headline. And then they subsequently released a report in July that shows a grimmer picture of where prices will be. And so the gist of it is, at the end of the day, nobody can really predict where the price is. There's certain factors that certainly affect the price, and that's what Robert and I are going to be talking about today. But Robert, do you want to start with sharing your charts, or do you want me to show some of the reports that we're going to be talking about? What do you want to do?
I'll start with the reports, because everybody has an opinion, and those fellows that put those reports out have a lot of time and data and vested interest invested in those reports.
And they are economists, so we got to listen to the economists and what they have to say, right? So,
well, no, we have to understand that they are economists. Yes. And have those blinkers on when they look at anything.
Fair enough. So there are three reports that we're going to be sharing. RBC's report focused on Canadian housing, which we'll put on screen shortly. July 22, 2022 is when they published it. Scotiabank's report, August 25, 2022. And TD Economics report on the housing outlook, August 29, 2022. So that's the most recent one. And Robert, thanks for pushing these into my inbox and bringing attention. Let's look at RBC's report first. So Robert, you'll see it on screen there as well. When you read the RBC report, the gist of it is, of course, in terms of mortgage rates topping pre-pandemic levels, and then there's a discussion between mortgage rates, interest rates in general, and affordability. And so there's a inverse relationship between price and cost of borrowing money. What did you find particularly interesting about this particular one?
Well, I guess I'm going to remember another one more correctly because I read it more recently than that
Okay.
one. But all of these fellows are trying to get a benchmark in the past, and
Mhm.
they're calling the pandemic an event. Well,
Yes.
in actual fact, the pandemic was a 2-month thing with completely unprecedented um, reasons and things that happened. We haven't had a lockdown ever before,
Mhm.
but it was a low point. So it's a low point that happened in the middle of a surge. And so the surge was going and then it quit and then it came back and
Right.
everyone was surprised by it. Anyway,
And
so this common point thing, this I used myself for another graph. And the only thing wrong with that is it's not long enough. It's
mhm.
only a couple of quarters on either side. And but what it does do is, and mine did too, was say that the from peak to trough in any of these previous unbooms or lulls or whatever you want to call it, normally they're high interest cycles, were maxed out at about 20% from peak to trough. So, um, it's interesting. It's this fella, no, Hogue. I thought it was Hog. It's Hogue. I saw him on a broadcast this week that was for a condo developer in Mississauga. He was able to put all these very same stats into reasons why you should buy these fourth phase, most luxurious of a Mississauga Square One town center condo. And the only sweetener was, for the first time, they were willing to do a prepayment of interest for 3.5% of the mortgage that you're going to get for 3 years. So it's like a 9.5, more like 11% discount that they're offering on their premium wonderful product that's just so great. You might as well buy it at the pre-construction.
Right, so
Anyway,
they're incentivizing. So as Robert said, basically there's certain periods of this. So this particular RBC graph report, they're using the home price index, which we can comment on that with a separate discussion, basically showing anywhere from -9.7 back in the 80s, 81, 82. And basically what they're saying is that this 2022-23 forecast will be -12.4% based on HPI, aggregate HPI, not, when we're
and
talking
Canada-wide.
and
Canada-wide is
Canada-wide, exactly. When we're talking 20-30%, we're looking at specific markets, namely Toronto, GTA, wherever the Toronto Regional Real Estate Board. So I'm going to link all of these reports here. But we also jumped then to Scotiabank Global Economics. And this one I found interesting when Robert shared it to me, because basically what they said is, here's the various mortgage rate scenarios and here's the various price scenarios. And so because of that relationship between mortgage interest rates and prices, it's everybody's just throwing, I guess, darts at a wall and saying, if this happens, this is probably what's going to happen, or if this and that. And that's another reason why the TRREB's report being released early is kind of significant, because of the fact that people want to see what August looked like and what we're heading into in terms of the fall market. So Robert, what are your comments on this particular
Well, the
report
most
here?
important thing is this has a different author than the normal monthly report from Scotiabank. That normally the Scotiabank report, go back up to the top there, is by, I believe it's a girl, Farah. And this time she has a contribution from Renee Lalonde, modeling and forecasting director. So that's where all the fancy stuff comes from.
Mhm.
Now, uh, the Scotiabank doesn't really care about real estate, but they always give some newbie the task, and same thing with the all of the reports on TV and whatever. You get some newbie doing real estate because somebody's got to cover it, but it's not the glamorous. If you want to be a financial reporter, you want to do the stock market, you want to do the bonds, you want to be on BNN, you want to be, if you in Toronto. So it's an adequate report, but the consistency of what they do every month is important, because then you can compare what they said last month to this month to whatever. They also, Scotiabank, want you to not invest, if you're an investor, not invest in the stock market, or I'm sorry, in the real estate market. They want you to invest with their product. So these are analysis done by bean counters who are not in the field, who want you to not give your money to their competitor, which is very natural and normal, but that's their a
Fair
preconceived
enough. And,
basis.
and and when we compare their peak to trough, basically they what they've done differently from the previous from the RBC report is they said, hey, here's 5 scenarios of where mortgage rates would be and what peak to trough would look like 2022 to 2023. And so they're kind of being a bit, I don't know if you call this conservative, Robert, but they're just basically spraying the possibilities of we can see anywhere between minus 8.7 all the way to minus 23.3 as the biggest possible decline. And so this report's interesting to read and compared to the other two because of that approach. But again, it's I don't think there's anything really significant being said here aside from the fact that, for one thing, yes, it's alluding to if you invest in real estate now versus stocks or versus any other thing that that financially they have to offer, it may not be the greatest thing, and in fact, it may be really bad if the interest rates continue to go bad. So let's jump to.
Okay, you hit it right there. Actually, the key point is nobody knows what the future will bring. You said it before, but they're laying it out so that they can't be wrong. If
Exactly.
the poo really hits the propeller, which
Yes.
is where they're saying if the highest interest rate scenario unfolds, then the maximum poo will hit the propeller. And this is what we predict that it might be. And so you say, oh, well, off by 41%. And again, it's Canada-wide basis, everything. But you can't say it's bad. It just has to be one more type of information that goes into your brain to give your own view on where you are.
Yeah, and it sort of feeds or validates the perspective of real estate bears or pessimists, right? So I mean, this market is different, as we'll see with Robert's charts, because there's difference in inventory, right? So the dynamic of the inventory on the market, the number of listings being introduced, how the prices are moving, and of course, prices generally are moving down, but are we seeing as much, like when you look at the supply demand equation, do we have as much inventory? And if there were more, if there was more inventory, would there be a greater price drop? So these reports are looking strictly at the relationship between costs of borrowing money for a mortgage and the prices that could follow as a result of increasing costs. But you also have to factor in there's other dynamics within each market within the GTA, by property type, by supply demand, by particular neighborhoods. And that's what Robert and I will talk about a bit more later on. Let's jump to the TD report, which is the most recent one that you sent to me. So Robert, what's your gleanings from this particular report?
Well, this one is very good as an example of the type that this particular individual, Rishi Sandhi, who I do not know, like we have a relationship at RE/MAX with TD, so we never say they're terrible, but they are always conservative and always wrong, the TD Bank. This guy he must go to the same school as the Liberal Party economist does, because he has a conclusion in his mind, and now he's backfilled the data to justify that conclusion. And again, you got to pick your dates when you're doing comparison, compare to what, and a lot of these things are being compared to the pandemic.
Mm-hmm.
The pandemic was a blip. It was in the middle of a boom that came after the interest rates had to come down from 2017 when sales were roaring. Anyway, they moved the interest rates up. This is the key ingredient, that it's not the pandemic, it's what interest rates are doing. And what I say now is that we had two classes of buyers in all the time. You've got specs, which is non-owner occupied buyers, and you've got owner occupied buyers. So when I say what's happening right now, the specs are gone. The specs are not buying. The owner occupiers are saying, what should I do? And we'll talk about this a little later on about what happened in the last 2 weeks of August. So what he's not seeing here is the specs are gone, and that what you're seeing them not in inventory, because what they bought in pre-construction, they don't have possession of, they can't really sell it yet. And most of them are saying, oh, I think it's going to be okay, so I'm going to rent it for a year. Now that's what he saw in 2017. We'll rent it for a year. Now you have a bad tenant. Now he wrecks the place. Now you're underwater. Now finally, when you get above water, you want to just dump it because you're sick of that thing. And as an investor, it's just a commodity that you're getting rid of. If you lose money, you just write it off against your previous income tax. You go back 7 years with it. Owner occupied is what I care about. What's happening to the guy who owns the house? He bought it last year. He bought it 50 years ago. What's he going to do? And the three things to look at is what's going to happen with prices, up, down, or flat, what's going to happen with interest rates, up, down, or flat, and what's going to happen with sales, up, down, or flat. And those are the things that these guys are trying to find words and economic principles to put it right, because you got to put a 4-page report together if you're going to get paid that much.
And it's based on forecasting. So I mean, of course, we can all have our personal opinions on each author of these reports, the actual brands that are pushing out these reports. But essentially, it's fair to say they're all saying similar things. Like nobody's saying anything differently. What they're saying is interest
How
rates,
can you?
prices,
About
exactly.
the future, yeah.
Right. It's just a matter of what model are they using and what those numbers spew out, right? And so part of the TD's report talks about, for example, during the pandemic, more expensive houses sold. I mean, of course, that's what raised average prices is more expensive home selling. And part of the reason being is, of course, people were looking at, hey, if I'm going to be at stay at home or work from home rather, then maybe I should be buying a home that will be my forever home. Not realizing that, of course, pandemics end, lockdowns get lifted, things return back to quote unquote normal. And now we're faced with a market where out of town homes are also declining in value. Demand for Toronto homes have maintained pace, or at least very consistently. We're hearing again, multiple offers coming back. And it's too early to tell whether this will be a prevailing trend into the fall market. Typically fall sales go up above summer sales anyway, and prices go with it. But all of these things are coming back. And one of the discussions as well in the TD report is with regards to the actual inventory in terms of the homes available for sale. And I was sharing a report with Robert this morning. This one came from the US. And so there's similarities, there's differences between the two markets. But when Robert shows his charts, the inventory levels right now are interesting in the sense, and I'm going to let Robert speak about that, but they're not the same as previous market changes or downturns, right? So Robert, let's look at some of the stuff that you want to share and sort of show where we're coming up with, some of our strategies and things we want to share with you, all of you watching this, in terms of making your decision for your next real estate move.
Okay, if we talk about inventory, we're talking about number of listings that are for sale at a given point in time. So what we pick is the last day of the month. What's active on that day? What's the inventory? Now, the Toronto Real Estate Board takes that number and gives it to us every month. And they also tabulate from the first of the month to the end of the month the number of new listings, which is normally an indication of turnover, freshness of new product coming on the market. And unfortunately, there's become a listing strategy that you put the property out for sale. And if for some reason you were too high, you were too low, but it doesn't work out right, you cancel that and you do it over again. That's and right. You put it through as a new listing, which gets counted again. And sometimes you'll be too high. And so you say, oh, that's no good. So you do it too low with a hold date, but you can go low enough. And so you have to do it 3 times in the course of a month. So you got too many listings. Now, as I was saying before, the specs are gone. So who hasn't come to the market is the owner occupied, grandma, okay? She hasn't sold her house in the last little while because it was going up at 1 or 2% a month. If you look right now, what happened in the last 2 weeks of August, which is normally a slower time, there was no slowdown in August. Exhibition times are normally the second slowest time. There was no slowdown. If you look at the pace, the number of sales, now, yes, we're down by 25% from normal or from a year ago, but it was 40% at the end of July. 25% is much different than 40%. So the sales are there, but the sales are there from owner-occupied people who are buying before the snow flies. They're buying something with a seller who will make a deal with them. They don't have to bid to get it. And they'll close the deal in October or something, right? Now, this is what we don't know from statistics, is what buyers will do in the future. All we know is what they did in the past. And what they have done in the past is wait until it became disadvantageous for them to wait anymore. This is a great market for buying up. And if you compare, let's say January the 15th, you have a semi and you want to move to a detached, And how much would you have had to pay in what type of a competitive market to buy that detached in last January? And what would you have got for your semi? And then compare it to if you did that yesterday, what would be the price be on those two things? And most people find that they're at an advantage today if they could find the right thing. So there's a lot of people who are just watching, beating the bushes, salesmen that got their eyes open, and then just when that right one comes along, bang, we're going to go after it. And there's two particular examples that happened this week of houses that sold before. And why did they come for sale? Why didn't an estate sale come for sale now when the actual transfer was done in 2019? The people, maybe they wanted to fix it up, maybe wanted to clear out, maybe they wanted to hurry, who knows what. They were waiting for the prices to go up and they didn't decide until this year and it was too late. Now it's less. But even so, they got 1.9 for a house that the family bought 20 years ago. And so who cares? $100,000. Okay, I'm rattling on about not getting to the point you want to get to.
That's okay. These stories are what make the market, right? So when you look at these individual situations of everybody, like, I mean, we're looking at charts, graphs, statistics, forecasts, and all that. We have to realize that individual cases or individual people are the ones making this market. And so there's reasons why things happen. Robert, do you want to put up some of your charts and we'll talk about it. And I think we're going to do a follow-up episode right away next week once we decipher and digest the stats that come out from TRREB tomorrow. But let's see what you have for now, and then we can talk about it.
Okay, well, as I was saying, there's two things that are of interest. Prices for the Toronto Real Estate Board last 4 years, 2019, 2020, 21, and 22. 22 is in orange. So we see prices trending down. I don't know what that thing shows. And now we're wondering what August is going to be. They gave us a little sneak preview saying that the price in August, average price, is going to be higher than it was a year ago. So it's higher than this blue line, if you can see my thing on it. And it's higher than last month. So this is very interesting because there's only $4,000 difference between a year ago price and last month price, 1,070,000 and 1,074,000. So traditionally, August is less than July, but it could just be that the buy up buyer, which is this is a good time to do, trade up buyer, prevailed, and instead of buying condos, those trade up buyers bought something for $1.1 million, and so the average price is going to trickle up just a little bit. So if we stop that and we go for prices, sales, again, we've got the same chart. This is from the Toronto Real Estate Board, and the orange is the trend that we're on. So the trend is not up, the trend is down. Last year's trend was also down. They say that the sales were higher than last year. So I'm sorry, the sales were higher than last month and not so bad compared to last year. So we'll see what comes out tomorrow when the Toronto Real Estate Board does their thing.
That'll be interesting. So we got to make sure this video gets published today in advance. But we were talking before when we were looking at the various price charts that just like which report was it? Just like Scotia's report, there's only really two possible things that could happen with August price, either higher or lower than last year. And if it did go lower, it would have signaled, I mean, it would have been a dip on the year over year, which would have broken the trend of even slight increases year over year, kept some kind of positive light in terms of just the enthusiasm about the real estate market, even though month over month we've been in declines, I mean, for obvious reasons. And so once tomorrow's report comes out, it'll be interesting to see what kind of sentiment, because at the end of the day, this is all about perception, right? What does a buyer think they're going into in terms of this market? And if they see that prices are actually rising, and if all the reports and media show prices are rising on a year over year basis, and relatively speaking to last month, prices went up. Once they see that, does their sentiment change? Do sellers all of a sudden enter the market and start listing, saying, hey, here we go. Maybe now is the time to make sense of this, make this move make sense, because I'm actually going to get the price that that maybe I wanted, maybe not as much as February 2022, but a little bit more than what I would have gotten in July. Now, plus fall market is, aside from spring, the next best market for these moves. I mean, typically when inventory gets introduced, it's, you know, second best season to do it. When prices are reported, it's second best in terms of average prices, right? So
Yeah, everybody wants to know when the bottom is. So you
exactly.
only know when the bottom is when it goes up.
Yeah.
So I
Now,
don't believe the TRREB numbers, but we'll see when they put it out, and we'll see whether they changed last year's number, because they revise their numbers all the time. But
right.
remember that 10,074 was last month, 10,070 was a year ago. So let's see what they come out with.
But we're going to save that juicy
normal.
stuff when the report comes out. So here's the last question we'll talk about, Robert, today, is that today we talked about two things that affect, essentially two things that affect price. One is the cost of borrowing money, which means the more cost to pay for, the more cost for a mortgage affects, of course, the price in a downward fashion. The second is supply demand, right? And so when you're looking at the supply demand part of this, and you see that sales, of course, have been dipping, but the actual amount of inventory is still low. When we see prices start to go up, it's certainly not because of interest rates have changed, because they haven't. And in fact, there's going to be an announcement, and interest rates may continue to go up, which technically speaking, prices should continue to go down. So Robert, how do we explain this then? Like, I mean, obviously, average price is based upon, you know, for that month, how many homes sold at what range. And if more expensive homes sell, then average price goes up. For a buyer and seller in this market sitting on the sidelines, so a buyer is saying, you know, I'm going to wait till the market bottoms and prices go up. This may be a false signal to them, right? Because if rates continue to go up, what will prices be come November, December, January, February, leading into next spring? So what would your comments and advice be on that?
Okay. If we have no spec market, we just have human beings that want to live in a house as their home, then they would go back to the idea of, I want to buy when it's easy to move. I don't want to move on January the 15th because it's winter. It's terrible. So everybody is looking for an advantage. And if the advantage is finding the individual house that you want, then you will pounce on the individual house when the individual house appears. Interest rates also are what you get used to. We got used to 1.5 to 2.5% interest, which is, you can't have interest that low. That was an anomaly. It's not a pandemic that we went through. It's a low interest cycle that we went through. But people will get used to 4 and 5% interest very easy, because that's what it is. Traditionally, like 8 to 12 was what it was. And once you get used to that, you get used to that. Now, if you've got more than 50% down, you don't care about that. The interest rate is most important for somebody who's got 10, 15, 20, 25% down. Because now you've got, with these prices, a huge load. So again, everybody is second guessing what's going to happen next. And what they're looking for, if it's an owner occupier, is not the whole market. They're looking for one property. And if they're going to move to it, then they have to sell theirs. And so they have to see what's advantageous for me. Is it now advantageous for me to sell? Is it now advantageous for me to buy? And am I able to do both with more comfort than I ever had in the last 15 years? And yes, they have the more comfort. So interest rates create the consumer confidence and the panic. The panic is really where the specs come from, is if they see there's no interest at the bank and the stock market's going sideways, then maybe I can have an investment in a condo. I can have an investment in a townhouse. I can rent out the house next door, whatever it is. So again, your question is looking for the answer of, it doesn't matter, but everything matters. That's, you know, if you're an owner occupier, everything matters, and you are cautious and you do only what's best for you. And if it's not best for you, you wait. And it may be that if they come out with another 0.75 rate increase, that everybody's going to go, June, blow their brains out saying the end of the world is here again.
Exactly.
So
Which will contradict I mean, it's going to be interesting because tomorrow news will be, oh, prices are going back up, and you're going to get that sentiment. And then when the interest rates next week are introduced higher, then you're going to get a question again about, where will prices go now, right? And that's a constant back and forth of this thing. And I mean, Robert, you put it out, but like the best way to put it is essentially, if you don't know, if you don't know what to do, just don't do anything and just wait and see what happens. I mean, of course, you're going to get into, some realtors saying, hey, now's the good time and every time's a good time to buy. I mean, there's truth in that. There's also negative aspects of doing that. I mean, if your outlook is long term, then yes, you could in theory buy at any point. And as long as you're holding on to it, because of inflation and because real estate just continues to rise for obvious reasons, supply, demand, and whatnot, it'll always be priced more X point in the future versus today, unless you're in the immediate down cycle. So if you're flipping a home, I mean, it's a high risk thing to do to buy something, unless you know for sure that there's some guarantee that you're going to sell it for more down the road, and that margin's got to be big enough to make it worthwhile, right? And if you were flipping when the market was going up, you look like a superstar. But then again, if home prices are going up 5, 10, 15, 20, 30% year over year, and you just did 100, 200,000 reno on a $1 million house, then of course, your $200,000, $300,000, $400,000 increase on that house wasn't necessarily because of the renovations you put into it, because of where the market was going. But if you're doing these kinds of spec moves in a downward moving market, is very risky.
Well, in addition to that, you've got the salespeople, brokers and sales reps who deal with the customers every day are a factor that never gets mentioned in any of these reports, because every one of those 62,000 divided by 5 that are active and actually have to make a living in the business, they have to make sales. And if they have a team, they got 30 guys, they have to make 5 sales every week just to keep their business operating. So there's always someone who will encourage you. There's always someone who will discourage you. And again, it comes back to you deciding on your own. Where do you think interest rates are going to be in a year and a half? Are they going to be up, down, or flat from now? Where are prices going to be up, down, or flat in 18 months? And where are sales going to be up, down, or flat? And you find the advantageous time for you. I'm directing all my thoughts to the trade up buyer and saying this is a great time for you, because the pace of the market is there. There is action if you want it. It's not as high as it was, but neither is your target as expensive as it's going to be. And you can move at your leisure. You can think about it for 3 days. You can put in a conditional on finance and home inspection and whatever you want. For the trade up buyer, which is really the lifeblood. No, first time buyer is the lifeblood of the business, because that's where it all starts at the bottom. But the trade up buyer is really what we're looking to help save and satisfy right now, because they can't go, they're a cork on the ocean. So they can't be affected by any fluctuations in whether the prices this month are higher than last month.
Awesome. So there's a conclusion. If you're to trade up, now is the time to make that move. Average prices will be up tomorrow. Sales will be slightly up from July. All positive news for the real estate market. So let's wait and see what the naysayers and the pessimists and bears say about it, and the skeptics. But hey, you know what? Everybody's got their opinion. And at the end of the day, you've got to look out after what's best for you, your family, your move, right? And that's what makes sense. So if any of you have any questions after watching this, our contact information will be here. I'm going to do my very best to post this video today, because tomorrow, everything we're talking about here would be overshadowed by whatever the report is. And hopefully next week, we'll shoot another episode, Robert, so that we can talk about tomorrow's Toronto Regional Real Estate Board report. Tomorrow being September 2. If you're watching this next week, tomorrow is September 2 from when we shot this video. Thanks again for joining us on Real Estate Chat. Thanks, Robert, for your time.
Good.
And we'll see you in the next episode.
Very good.